Wolf Richter joins me now. He's the publisher of wolfstreet.com. Wolf, welcome back.
Thanks for having me back, James.
Sure. Wolf, you have been covering the Fed for quite some time. The Fed has started to sort of underwrite the market. Is that the right way to say it? By sort of creating, I guess the last one was $120 billion in the overnight repo market. Does that constitute quantitative easing?
It certainly provides liquidity to market players, and in some corners, liquidity is now a little rough to get. It's so yesterday had an overnight repo of 120 billion. Today it was 100 billion, but they unwind, and so yesterday's is gone today, and it was replaced by today's repo. But it has new repos out now. It did a 25-day repo for $50 billion, so they'll be hanging out there for 25 days. And it upped the 2-week repos to $45 billion. So this is a significant amount of money. It'll add up to about $100 billion that the Fed increased its liquidity to the markets over the last few days. But given the trillions of dollars that have evaporated from the market, from the equity markets, over the time period, it's not a huge amount. And obviously, the economic problems and the financial problems too are so huge that 100 billion isn't going to change a whole bunch.
Sure. And so, from where you sit, I mean, it seems to me that, yes, the coronavirus has certainly catalyzed what is going on in the markets now, but it has more or less just really revealed the fragility and the sort of artifice that has gone into the valuations across all markets for, well, as our position here is that this is merely a resumption of the financial crisis that began in 2008 and was only temporarily ameliorated by quantitative easing and zero interest rate policy. Is that kind of what you see happening?
Yeah, I took out a big short position on December 30th that I published back then, and for that very reason, that the market was incredibly overinflated. The market enthusiasm and the exuberance was bigger than I'd ever seen in my life before. There were all kinds of underlying fundamental issues in the economy. That was before the coronavirus came along. And I figured that this can't go on like this. People were expecting the Fed to underwrite the market forever. Every year we're going to get 30% increases in the S&P, even when the economy is barely growing or is not growing at all. So that just doesn't work. And that was obvious before the coronavirus came along. And so now we've got the coronavirus on top of it. And it really reveals, like you said, how fragile this market is, how overinflated it is, how easy it is to just blow it apart. And, we got the SARS virus back in 2003, and that came after the stock market had crashed in 2000 to 2002. And it barely dented stocks, because they were at much lower levels, and they were at some sort of level of stability. Now we've got this incredible, and now it's down 25% from the peak in just 15 days. And it's still overinflated. It has to come down a whole lot more before it reaches some stable levels. Mm-hmm. And the coronavirus is just revealing, how overinflated the market is.
Mm-hmm. Yeah. So, I hate to put you on the spot like this, but so what is the number that we look for in the Dow and the S&P that you think is a sort of expected kind of bottom? And what time frame is that going to happen in?
Oh boy, my maxim is that nothing goes to heck in a straight line. And so if you look at the S&P chart right now, it's going to heck in a straight line, and that can't happen. So I'm going to cover my short later today, probably. I expect a violent bear market rally pretty soon, tomorrow, day after tomorrow here shortly. And then I expect the whole procedure to continue. And, I've been through 3 crashes in my life, traded through three crashes starting in 1987. And in 1987, I didn't really have a lot of money online. I was just starting out, but in 2000, I did, and then in 2007, 2009, and you know, to me, it looks like we're going into the fourth crash of my lifetime. And the last two produced results where the S&P 500 dropped over 50%. During the dot-com bust, the NASDAQ dropped 78%. Then I'll look at other major indices around the world. Shanghai Stock Exchange, which is down 50% or so from its peak in 2008. The Nikkei, which is down over 50% from its peak in 1989. That's 30 years ago. And German DAX, DAX K. The German DAX is a total return fund, so a total return index. It includes dividends, but the S&P 500 equivalent is the DAX K, and that's down 32% from the year 2000. The other European indices are similar. If you look around the world, the U.S. stock exchanges are kind of the exception in that they reached new highs this year or in prior years. Most other indices have been down for a decade or two. And I expect the same kind of scenario for the United States. The exception can't be maintained forever. And I think we're looking at a fairly large downdraft and many, many years before we get back up to that peak.
Mm-hmm. The other crashes that you lived through in your lifetimes, savings loan 87, dot-com 2000, and the housing crisis / asset-backed security crisis of 2007 to 9. Those are, to me, remarkable because at that point the Fed had not adopted this strategy of inflating the liquidity in the marketplace with such a bend. And the balance sheet in 2008, I believe, stood at somewhere around $500 billion and only reached $500 billion and only reached $4.5 trillion towards the end of the cycle of inflation of the liquidity at the hands of the Fed and in the last decade. So, I mean, to me, it seems like, well, if all of that false liquidity is the first sort of level of evaporation we're going to see in terms of valuation, and then we start to see, real valuations deteriorate, I see a potential where, yes, the Dow and the S&P lost 50% in 2008. They lost 35%, in 2000. $5 trillion got evaporated. But that was real money. That wasn't fabricated money. That wasn't debt that was fractionally banked out or whatever that process is. But so is it potential that this could be, in fact, the numbers could be far lower before we achieve a bottom, inclusive of all sort of bear market rallies?
I think the real issue here, and you could be right, the real issue here is the credit market. Corporate debt has reached record highs by any and all measures. It is ridiculous what these low interest rates have encouraged corporations to do. Yesterday, I just wrote about Boeing, which blew $43 billion on share buybacks, and now it's got an existential problem on its hands because it doesn't have enough cash to deal with all issues, and it was able to borrow this money pretty cheaply, and other companies were too, and they just blew it on share buybacks. So now we have the credit market, meaning bonds and loans, much of it junk rated, that is starting to struggle with the company's inabilities to service that debt. So I think you will see upheaval in the credit markets, and that will cause additional upheavals in the stock market. But the losses will impact the credit market. So there will be a lot of bankruptcies, and some of this debt will go to zero. And so there will be real trillions that won't be there anymore. And so the stock market is only part of it. The credit market is huge, and the corporate credit market in the United States is gigantic. And including the loan market. So I think this is a very broad-based downdraft we're looking at here, and the stocks are only part of the picture, and that could go down 50%. I think that's a pretty realistic scenario. We're already halfway there, so we don't have that much more to go to get to minus 50, and we got it in 15 days. So it could go a lot lower. The Japanese Nikkei went down a lot further than 50%. It's still down 50%, but it went down a lot further, as did the Shanghai Stock Exchange, as did the German DAX K, and many others. So there's a good chance this could drag on for a long time and could be a very deep plunge.
Sure. The plunge that occurred at the end of 2008 was only interrupted by the advent of what was first the Toxic Asset Relief Program, but was essentially the advent of the Fed buying assets in large scale from the various troubled segments of the financial system. And that had the effect of, giving the market the impression that, okay, the Fed is going to step in and put in a floor on this just through outright asset acquisition and capitalization of the system that way. That option is not really available at this time. At least it's not going to be novel. And in fact, at this point, we have to ask ourselves, well, to what extent did all of that capital fabrication compound the stresses in the system to catalyze this again, another market blow up? So what could they possibly, what are the tools left to the Fed, I guess is my question, that they can deploy to arrest the plunge now occurring in the markets?
Well, they will certainly act as lender of last resort. So as they did during the financial crisis, when big companies and big banks starting to run out of liquidity, the Fed will provide funding when the market refuses to fund those entities. And during the financial crisis, GE was looking at the possibility of not being able to meet payroll because it was funding its operations in the short-term markets, in the corporate paper market, and that corporate paper market froze up, and suddenly GE couldn't borrow anymore, and it needed to borrow because it didn't have enough cash on hand to meet payroll. And so the Fed stepped in, and GE wasn't the only one. There's lots of companies like this, and of course at that time the CEO of GE, what is his name, Infeld, I think, he was on the New York Fed's board. And so the bailouts were handled that way, where the Fed acted as Immelt, that was his name, where the Fed acted as lender of last resort to big industrial companies in addition to the banks. And the Fed is already making noises about that. They will assure that when the short-term funding market dries up for these companies, that they will step in and make sure that these companies can meet payroll. Now, that doesn't necessarily cause stocks to go up. That just prevents these companies from dying in a liquidity crisis. But they will still have losses, and they still will have other issues. And as we have seen in Japan and in Europe and in other places, the Bank of Japan has been doing QE for decades, and they've had a zero interest rate policy in place for decades. And the Japanese banks the stocks are at levels where they'd been in the early 1980s. They're completely crushed. The Japanese stocks overall are still down 50%. Now, the Bank of Japan's manipulations of the markets has only been able to support the government spending and the government debts. It has not been able to really support the markets. And it's the same kind of things in Europe. The European Central Bank is mostly interested in keeping the Eurozone glued together, not in inflating the stock prices of the banks. And so its program has succeeded in keeping the Eurozone glued together, but the banks are the bank stocks are at lows not seen since 1988. So I think we could look at a similar scenario where the Fed is able to prevent catastrophic collapses of some sort of another of real companies, but at the same time stocks might not make new highs for way beyond our investment horizon.
Sure. You bet, Wolf. I so appreciate your insight, Wolf. It's very spot on as usual. And so we're going to leave it there for now. And I hope to come back to you soon. Thank you very much for your time.
Thank you, James.